Happy Sunday, happy Sunday. Welcome, everybody, to another educational session brought to you by Benzinga. With us today is Matt Maley. If you don't know the man, look him up. You should know how to Google, right? Matt's going to teach us all about fundamental and technical analysis and his approach to the markets. This man is good at what he does. To kick us off, why don't you guys do me a big favor? Let me know where you're watching from and your first name. Drop it in the chat. And as always, if you are watching on Zoom right now, that means that you registered for this event ahead of time. You will get a recording afterward. I repeat, you will get a recording afterward. I repeat, I promise you'll get a recording afterward. So if your neighbors, your fellow traders are asking, be a good member of the community and let them know, yes, you will get the recording afterward because people will ask. It's human nature. Oh, already, like right off the giddy up. So we start off with Idaho. Hi, Daniel. And then MD, I believe that's Maryland. I'm terrible with state abbreviations. What up, Tony from South Florida? Philly. Oh, excuse me. That pre-webinar energy drink got me like. And then we got Italy. Nicola and Danielle, thank you so much for being here. Savannah, Georgia. John, the weather is beautiful. Why do you guys always feel like rubbing it in my face? I'm in Detroit. Actually, it's not bad. I'm in Detroit, Michigan. The weather is the weather is gray. Let's say it's cloudy with a chance of gray. Yeah, so I like this trend, guys. Let me know where you're from and let me know the weather conditions. That's going to be the best way for us to get started. Mark from Georgia. Mark from YouTube. Scott from Newport Beach. What's up? Tony, you're the man. Ooh, Singapore. And it's hot and humid. I hope you've got air conditioning. Ooh, a perfect sunny 60. Dang. Sheesh. Yeah, right, Scott. Oh no, it's raining in Southern California. Looks like we do have Matt on webcam. Matt, we're gonna get started in about 6 or 7 minutes, so you can go ahead and turn the camera off and just chillax. I know you're there. Yeah, Matt's there with his actually I think he pays him now. He's there with his paid IT support technician, his son. So everyone say, hey, Matt. Matt, and hi, Matt's son. What's up, Kev? From Los Angeles, California. A sunny 70, Mark. Oh, man. Yeah, if you can handle the crypto volatility, then throw all of your money in the market. Hey, that's what you're here to learn about. Here's a little pro tip, guys. You're allowed to ask Matt about cryptocurrencies. You can analyze those too. There's obviously not as much fundamental data to work off of. There's really just a story and maybe some news. But we can look at the technicals. Donna from Alberta, Canada. Greg, ding, ding, ding. First one of the day. Is there going to be a recording of this? Folks in the Zoom chat, you guys know the answer. If one of your neighbors, your fellow traders, investors asks if there's going to be a recording, what do we say? Yes, of course. If you registered for this event, excuse me, you will get a recording. Rodrigo, hashtag accept Doge. We'll see. We'll see. I'll tell you what, I will put my wallet address in chat. I accept Doge as a business. In my business is I give out compliments. If you send Doge to my wallet, I'll deliver a compliment within 24 to 48 hours. And if you are on YouTube, make sure you smash that like button. Really appreciate it. Mitch from Illinois, hello, hello. Ron from Seattle, hello. Is it Morali? Am I saying that right? Morali, perhaps? From Toronto. Sunil from Sweden. We have strong Swedish representation here at our sessions. I'm gonna make the case. We're gonna accelerate that Bensinga office project out in Sweden. See if we can get that thing done. Got a couple calls to make. It is free to register for this event. That's right, and that's the only way to get the recording and priority chat. Yeah, Mark. See, Doge has a use case for tipping. Yeah, you can tip me. This is not Neil. This is Neil's twin brother, Nick. Neil does the weekday thing. Nick, this is me. I'm Nick. I do the weekend stuff. So Sweden, Toronto, guys. Just a reminder, who are the guys that are just getting here, guys and gals, and everyone else. Let us know your name and where you're watching from. And if you're feeling good, let us know what the weather's like. And in case you missed it, if you are registered and watching in Zoom, you get priority chat and you will get the recording of the session afterward. Fausto from Orange County, what's up? The weather is bleh. I can relate to that. Nice. What's up? Kentucky. Owensboro. I've never been there, I don't think. Welcome, Lee. I'm up in Michigan, but I love that drive going down south. Kentucky, Tennessee. Once a year, I try to get all the way down to Alabama. Good friend of mine has a bunch of family property down there. Love that drive from Michigan down through the southern states. Alexandre from Brazil, welcome. Virginia. D-Bull from New Jersey. Linda from Florida. 85 degrees, of course. You don't even need to say so. Beautiful and sunny. Yeah. Canada. Yeah. Keelan is in Canada in lockdown, so does not know the weather, does not care. All right, guys. I'm gonna keep Matt backstage for just about 90 more seconds so we can get more folks to trickle in here to the registered session. Keep letting me know your name, where you're from. Keep in mind, this is an opportunity to ask questions about stocks and cryptocurrencies that you care about. Double Baconator. Dude, why are you trying to make me hungry, Mark? Yogesh from Canada. Beautiful weather in Pittsburgh, Pennsylvania right now. 70 and partly sunny. Hudson from Uganda, welcome. What is the air velocity of a swallow? About 70. Oh, wow, John, happy birthday. Happy birthday to John, who decided to hang out with us today and become a better trader. John, here's my promise to you, that if you pay attention to what Matt has to say today and you take notes, and happy birthday, Daniel, I promise to both of you, and you take notes and you listen, you will come out of this a better trader than you were coming in. You will, let me state that even better. That was pretty weak. You will come out of this feeling more confident and capable in your ability to make the right decisions on Monday and in the week ahead. I guarantee that. As long as you listen, as long as you pay attention, and when you have questions that are relevant to the conversation, you get those questions out, you're going to come out of this a different person, at least a different trader. Tony Ross, pumping the V chain. Yes, if you are registered and you are watching on Zoom, this video recording will be available to you afterward. Just watch your inbox. You'll get it. All right, guys, the countdown has reached its terminal point. Matt, would you mind coming out? How's it going?
Good. What's going on, Neil?
Oh, I'm just hanging out here with the chatters, getting everybody ready. Sounds like we have a nice global audience as usual today. What's going on with you?
Not much. Just enjoying beautiful weather out here, and it's great that even though the weather is real great, I still love to talk about the markets because it's an unbelievable time in the marketplace, and I think it's going to be that way for quite a while, quite a few years. But not only that, even over the summer when things tend to get kind of dull, but that's usually when the best opportunities present themselves.
I'm very excited to see what you have to say about summer 2021. Given everything that's happened over the past, 15 months. Very excited. So Matt, would you mind giving folks a brief introduction to yourself and what you're going to present today?
Sure. Yeah. Just there's a little bit quick on my background. Is that I've been in the business on Wall Street for over 35 years. Started at it's interesting because on top of writing the Benzinga Stock Picks newsletter, I'm also the chief market strategist for Miller Tabak. You may have seen me on CNBC or Bloomberg. I'll be on CNBC this week, I think on Wednesday. But anyway, but my work is a lot different and very unique compared to a lot of other people, most other people, because really the most of those other guys were either former economists or analysts, and that's fine, and they do a nice job, but they tend to focus more on what should happen rather than what is going to happen. And I spent my first 25 years in the business trading. Worked on the trading desk at Salomon Brothers, which in the 70s, 80s, and 90s was one of the most important trading desks, the most powerful trading desk on Wall Street, and then went to Merrill Lynch for almost 10 years. So combined 25 years, and covering it when I did that, I covered the trading desks of some of the biggest mutual funds, biggest and best mutual funds, hedge funds, insurance companies, et cetera, who trading millions of shares every single day, and really learned about not just what should happen, but what really is going to happen and what does happen and why. Because one of the things I've said a million times is that people always say the market's always right. That's the worst old saying on Wall Street. The market is only always right eventually. And that's where short-term active traders can be really maximize their returns. And that's really what I want to talk about today. I mean, we have, everybody has their long-term bucket, and that's great. You want to have a good chunk of money in that's looking 3 to 5 years out or 10 years out or longer. And then have another bucket that may be a little bit more intermediate term, and then a more short-term active trading, where you can really, where the fundamentals aren't as helpful at key turning points. In fact, sometimes they can be detrimental. But my trading experience has been able to get me to see the kind of the big when the key turning points are taking place, not just in the overall market, but in different asset classes, different individual groups, and of course individual stocks. And again, my trading background has helped me to really work on that. And the one I'm going to talk about is that fundamentals are very, very, very important. But really, in all the best, especially these big hedge fund managers, all of them use technical analysis to a significant degree. Stanley Druckenmiller, Jeff Gundlach, George Soros, all these guys, they all, Paul Tudor Jones, all use technical analysis very extensively, because it helps them on some of the shorter term trades, and really helps them maximize their returns. And that's really what I hope to do, to help investors in that, with that Benzinga newsletter, where we have a tier 1, tier 2, tier 3 that touches on each one of those 3 objectives.
And coming soon, a tier 4, if I'm not mistaken, Matt.
Yes, that's what we're
working on.
Rank up very perfectly.
Yeah. So guys, we Matt and I only just recently talked about this. We are launching a chat room here in the coming week. Matt is reaching out to his IT support now, but we are launching a chat room so you can keep in contact with Matt on a regular basis. Here's what I have to say about Matt. When he says something is coming, I listen. That is one of the things that really has just impressed me consistently over time. Is if he starts talking about a correction, it usually happens. So not saying he has any magical powers or anything, but he does have technical and fundamental analysis chops. So Matt, let's go ahead and get into it with your screen share so you can show us exactly how you do that.
How's that?
Hit the present button.
There we go. How's that now? Hopefully, oops, wait a minute. There we go.
Perfection.
Okay, great. Okay, good, great. So we're all set. And my IT man, thank God, stays with me all the time. And good job, Pete. Thanks, buddy. He's the best. So anyway, just let's get right into it. Again, the thing is that we want to combine the two, and too many people I think focus a little bit too much on fundamental analysis, and that is, don't get me wrong, it's very, very important, but especially nowadays with the way all this excess liquidity and stimulus that's been added to the marketplace, those fundamental analysis it hasn't been as helpful as it had been in the past. But more importantly, the market can always move in different ways. I mean, the example I always like to use is Amazon. I mean, Amazon has been an unbelievable company. It's changed the world over the last 25 years, but it's still seeing 24 or more, at least 24 corrections of anywhere from 20 to 60%. So in other words, even though fundamentally it's an unbelievable company and they're doing all the right things, sometimes the stock gets way ahead of itself and it presents opportunities to take profits or even get short the stock or buy puts in the stock. And then other times when it gets oversold, and you can really not just own the stock, but double down on the stock or triple down and buy call options or et cetera. So that's why we're trying to, through active trading, we can get to maximize those good long-term returns. The one thing is, if you try to time it exactly, it never works. You never get the exact bottom, exact top, but you can, I think, using these tools can really get that kind of excess returns that a lot of people don't get. I mean, I talk a lot about, if you use technical analysis only, you get that middle 70%. They're always looking for that confirmation. And that's great. And we do use it to add to positions or even to subtract positions, that 70% in the middle. But that 15% on either side is where the big amount of juice is. I mean, you think about it. If you get something at $10, you buy something at $10 just as it's bottoming. Now, again, you may get it at $10.25, not the exact bottom. But you get it at 10 and it goes to 30, you've tripled your money. Those technicians that only use technical analysis, they're the ones who are saying that it gets to 15, that they get confirmation. You're still very happy because you doubled your money, but man, tripling your money is a lot better than doubling your money. And that's what we're really trying to get, that extra juice. And another thing on the fundamental side, that if you're only using fundamental analysis, you don't necessarily see the turn because you don't see that the positioning has become too extreme. It's one of the things I had in the energy sector when I made a great call in the energy sector early last fall, turning bullish. The people who only followed the fundamentals didn't turn bullish until early this year or even just in the last week, and they missed a huge part of the move. So again, this is the thing where it's not just short-term trading, but long-term trading. You can get that full juice. And again, you're not going to get 100% of it, but we want to get more than just the 70%, I guess is my point. So, again, we want to use both. My key is that, I always, like I said, the market isn't always right. The fundamentals are very, very important, but we have to always look beyond the fundamentals. It's just something. There's just too many opportunities that have arisen. I'll go back to that situation I mentioned with the oil stocks and the energy stocks. I mean, no matter what you think about fossil fuels, people say, "Oh, fossil fuels, these energy companies, they're dead." It's like, well, number one, a lot of them are making the transition. Number one. Number two, as much as we want to get away from fossil fuels, it can't happen overnight. It will take decades. I mean, not just one decade. And so there's still plenty of opportunities to make money in that sector. And it's not all in the technology sector. So, but those people who are looking only at the fundamentals really missed out and are very, very late to the game. But the thing about the key thing is that they are very different. But technicals are much more than just a bunch of lines drawn on a chart. Think about it. Technical analysis is absolutely fundamentally based. And if you get a company, the company has been having a tough time. It's been 2 years, or sales have been down. The number of different reasons. Doesn't matter why. The stock is down because their results have been down. Their fundamental returns have not been good. Then all of a sudden things start to get better for whatever reason. Maybe they have a new product. Maybe their products are suddenly coming back into needed a lot more. A number of different reasons, but for whatever reason, suddenly the company starts to be doing better. Okay, what happens? Well, the managers go out and decide, okay, we've got to hire more people. We've got to reopen our factories. We've got to not just hire people, but we've got to train them. That takes time. And you can't retool a factory overnight. You can't hire people. You've got, first of all, you've got to interview them, then you've got to hire them, then you've got to retrain them. That takes time. So the point is, you're not going to see even though their business is picking up, their earnings aren't going to get a lot better right away, because it's going to take time for them to ramp back up to get those much better earnings. The thing is, though, for those people who work at the big mutual funds and big hedge funds, they've got an army of analysts, okay, that tell them, they say, hey, listen, XYZ company is hiring more people. Their orders are coming in. It's going to be great. Their earnings aren't going to get better for 9 months or even maybe a full year, but don't wait. Buy it now, because they're definitely going to get better. And so those guys are going to start buying the stock, and the stock starts to move up, and they break resistance level. So in other words, stocks move. We always hear all the time that stocks move, stocks bottom 6 months before the fundamentals do, and they top just before 6 months before the fundamentals turn down. And the same thing with the economy. I mean, you hear about how the stock market always tops out 6 months before we go into recession, and the stock market always bottoms 6 months before we come out of the recession. And that's the reason why. It's because people see it's already happening. It's much easier to buy a stock. All you have to do is push a button nowadays. I mean, you can buy it immediately. Where to get your earnings to turn around, that takes many months. So it is fundamentally based. It's a great way for those of us who don't have an army of analysts to see things happening quicker than we otherwise would. And then we can kind of go and say, hey, this stock's starting to break out. This thing must be getting good. I'm going to buy the stock. I'm going to do a little bit more fundamental work on it, see if things are turning around, et cetera. So it's a great way to equalize the playing field with all these unbelievably talented and sophisticated investors on the institutional side of things. So again, we're going to do a little bit of a tutorial here to start about what we talk about with each one, and then really talk about how how I've been able to put these together to make some really great calls and great investments on these picks that we make in the Benzinga Stock Picks report. Obviously, earnings, that's the number one thing. I mean, earnings is what we're looking for. That's, again, you want to discounted future cash flows. We don't care what a company's making today. We're trying to figure out what they're making, not only what they'll be making in the near future, but in the long future as well. But, you always hear about earnings per share. And that sounds, I'm sure from most people, it seems obvious, but sometimes it doesn't, you're not really fully sure. And the reason why we care about earnings per share is that, very simply, you have company A, they're making $10 million a year. You have company B, they're making $10 million a year. Their stock should be at the same price, right? Or $100 million, whatever. If they're both making the same amount of money, the shares should be at the same price. Except the fact that company A has twice as many shares outstanding than company B. So therefore they're more diluted, and therefore they shouldn't be trading at the same price. And that's why we go, so to compare apples to apples, we go earnings per share, because different companies have different number of shares outstanding. And then, of course, the price you've heard all the time, the price to earnings ratio, PE ratio, price to book, the book value of the company basically is the breakup value. When companies, sometimes like we had bank stocks trading below book value for quite a while there. And that was the whole fundamental thing. And I'll go, we don't want to look only at fundamental analysis because the people were buying the bank stocks for 2.5 years and they continued to underperform. I stayed away from them until last fall because the yield curve was flattening and interest rates were heading down and they were going to continue to head down. When I saw that they were going to turn back up in August and September, then I changed my stance on that. And then it was like, okay, now's the time to really focus on the fundamentals because the technical backdrop is getting much, much better. But again, the one thing though I do like to look even better is price to sales. Price earnings, they can, companies can very legally play with their earnings, and there's tax losses and gains, and there's all sorts of things they can play with their numbers. Your sales are your sales, okay? Unless you're flat out cheating, those are the numbers, and so they're the most accurate data point. And that's one of the things we have to worry about right now in the overall market, because the price to sales of the S&P 500 is actually more expensive than it was in 2000. But the PE ratio is much lower. Again, I'm not trying to scare people and think that we're going to have a big crash, but the point is, there's a good chance we're going to have a correction, a decent correction before the year's over. We have one almost every year. And my whole thing is, and as we go through this whole presentation, we talk about how my big thing is to help you in both. You can make money. A lot of people say we want to help you, kind of weather the downturn in the marketplace. I'm not. I want to help you do that to a degree, but more importantly, I also want you to be able to profit from that, not just weather it, profit from it. And nowadays, in the old days and back in the 1990s and even into the 2000s, the big guys, they were the only ones who really had the tools to be able to take advantage of that. It was much easier for them to short stocks, to buy options and sophisticated strategies. There were no ETFs. It didn't matter to them because they had the ability to do these things. But now the individual trader has those opportunities. Yes, you can still short stocks, but more importantly, the options back in the 1990s, any option, they only had 4 expiration dates. So you had 4 times a year. So every time you bought an option, it was way, its expiration date was way out into the future. And that meant that they were going to cost you a lot more money just because of the present value of the money. And the thing is, though, is that now they have shorter term options. Basically all the big names have options that expire every week. Apple Computer and those, and even and the ETFs, like the real big ones, the SPY on the S&P 500, the IWM, which is the Russell 2000 ETF, and the QQQs, which is the NASDAQ ETF. They expire every Monday, Wednesday, and Friday, 3 times a week. So you don't have to pay that huge time premium if you want to make a short-term bet. And then, of course, we have inverse ETFs and 2 times inverse ETFs, et cetera. Those you have to be careful, especially with the leveraged ones, because those are very short time ones. Because they're leveraged, you only want to hold those for a week, maybe 2 at the most, and even for a few days. But if you see a big 5 to 10% move, suddenly it turns into a 20% move. But you can buy them; they're very liquid, and again, so we want to be able to take advantage of that when it comes, because, like I said, the market very, very expensive here. And free cash flow, that's another thing that we want to see how much a company has. One of my best calls on Apple was pounding the table back in June of 2019. People forget that people were turning down on Apple because they had lost all their innovation. Steve Jobs wasn't there anymore. There was nothing new that was coming to them. And I'm like going, I don't care. I don't know that it's got the same innovation that it used to have, but its free cash flow is off the charts, and it's a cheap stock. You got a pound at the table, and that you needed to buy the stock. And I stayed bullish on that thing all the way up until last fall when the entire FANG group kind of leveled out. And again, that was another reason that I used the technical analysis to come up with that. And the last thing is debt levels, debt to equity. Not that worried about it yet, but if we do, someday we will have another recession. And something we want to be careful. We want to keep an eye on debt levels for companies, because in a recession, it's going to be much tougher for them to service that debt. And again, those are the ones you want to stay away from on the long side. You don't want to be buying them, or at least not aggressively until they become very cheap. And even maybe you want to short. But right now, I'm not as worried about that. But that's one in the future. And then, of course, we always want to look at the global, the top down, more macro situation. That's kind of where I start on any any point in the marketplace. Obviously, both the U.S. and global, and the valuations that we talked about, not just earnings on individual companies, but the broad earnings. Are they coming up? Are they going down? One of the things right now on the S&P 500 is everybody's talking about how great the earnings are. But I'm like, yeah, they're going to be up 35% this year. But that's compared to last year. I mean, pre-pandemic, year, the last time, the pre-pandemic year of 2019, we had earnings, we're going to have 12% earnings growth. That's pretty good. The only problem is the stock market's up 40%. So it's already priced in a lot of that earnings growth. So again, we have to be careful on some of these things. That's another reason why, although I think we're going to make a lot of money going forward on the long side, we want to be keeping a close eye for any kind of sign that the market's actually going to turn down in a significant way. Let's just go ahead here. Let's go and move on to the technical analysis. And again, it's not just fundamentally. I'm sorry, it's not only fundamentally based, like I talked about, but it's also based on momentum. And again, as I mentioned, those technical analysts, really, those technicians really try to get that 70% in the middle. But once it gets going, that's a good one. You want to go with the flow, and we're not afraid to buy things. Excuse me. And one thing I want to talk about is that, say we bought, remember I talked about buying something at $10 and the technician's buying it at 15. We're going to buy it at $10 and then add to it at 15. And a lot of people sit there and say, oh my gosh, I don't want to, geez, I wish I bought it all at 10. It's really going well now. It's like, don't worry about that. The professional guys get new money coming in all the time. And they're adding to their winning positions at much higher prices. That's okay. And think about it for a second. You buy something at 10 and it goes to 7.5. You've got a losing position. Okay, if you add to it, you still have a losing position. Your average price is a little lower, but you still have a losing position. Okay, now you've got to pray that this thing comes back. On the positive side, if you buy it at 10, it goes to 15. Now your average price is 12.5, and it's trading at 15. You're adding to a winning position. So you can basically all but guarantee that you won't lose money because you have your stop level at 12.5. It gets to 12.5, I'm out. And it's no, and of course nowadays with zero commissions, it doesn't cost you a penny. Okay, and then as the stock continues to rally, you raise your stop out level, and again, you're pretty much guaranteed to make money. Now, of course, there's no guarantees in life. The company may announce that they're going bankrupt overnight one night, and it could fall 25% or 50% or something crazy. But that usually doesn't happen. In most cases, it's a much better way to play. Do not be afraid to add to stock. That's what technical analysis can really help us to, because it can not only tells us where to enter, but it also tells us where we can add to a situation. We still check the fundamentals. Do the fundamentals still check out? Yeah, they're even looking better. Well, that's great. But what is the technical saying? It's getting that kind of momentum that we talked about, and it's going to go a lot higher, and we can add to it with a lot more confidence. So let's just talk about some of the basic aspects of technical analysis. We could spend hours talking about it, but one of the things is you hear about all the time on Bloomberg or CNBC or any of the other financial news outlets, the 200-day moving average. Also, I just put, usually you'll see if I put it on a chart and other people, you'll see just DMA. That means day moving average. So 200-day. 50-day, and a lot of people use the 20-day moving average as well. I don't use that as much as a lot of people do, but it's still a good one. And there's even times like right now, the 100-day moving average is something that most people don't look at, but it's actually a critical one right now for the semiconductor stocks and the NASDAQ overall. It's been a key support level, and whether those indexes can regain those 100-day moving average next week or roll over is going to be very, very important for the market going forward. But here's an example on the 200-day moving average. Here it is at Bank of America. You see what happened last year. I mean, remember, it was just like everybody was really bullish. The group was going up. The stock was going up, but it was underperforming the market. You're much better off on other stocks. But it kept bouncing up that 200-day moving average 1, 2, 3, 4 times. It finally breaks above it and then rocket ship much higher. See how that can really work. And so for different stocks, different moving averages are important. But the 200-day, because that is basically a full year of trading, that's one that people look at very closely. 365 days in a year, you take out the weekends and holidays, it's a little more than 200 days, but that's the number to use. And the 50-day is about a quarter of trading. Again, it's a little bit less than a quarter of trading, but again, since it's the round number of 50, those are the ones that people look at. Whoops. Okay, trend lines. This is a perfect time to talk about. So, well, trend lines is pretty obvious if things trending down or trending up. And when you break that line, it shows a change in trend. And that's when, again, when you get that big change in trend, suddenly people, especially the big guys, decide, I've got to get out of this stock, or I've got to get into this stock. They can see powerful moves. And so we always want to look at trend lines. It's a good spot, though, to take it says here, be careful of only slight breaks above or below a trend line. And the reason why I say that, it's not just trend lines, anything. If you above, below a moving average, above or below any kind of support or resistance level. If it's just a few pennies, 0.5%, it can frequently be a head fake. So you have to be careful. Don't get too excited right away. You can buy a little stock, but you really want to make sure it's 2 to 3%. Most technicians say you want to be 3% above it. I'm more in the 2% range. But then again, the really volatile stocks like Tesla, you probably want at least 5% above or below a key support or resistance level before you really get confirmation. But just this is very important to see. If you have $50 as a key resistance level and it trades at $50.10, that's not a breakout yet. You got to get it up to 51, 52 before you really get $51. That's about 2%, and it works well. So again, let's just look at these trend lines. Now here's a situation where, again, here is the trend line. This is the yield on the 10-year note. Okay, last year, remember, I turned bullish right in here, okay, but I doubled down, and so I turned bullish on the bank stocks. But I doubled down, didn't do it here because it only got a very slight breakout. See where the arrow is there? Very slight breakout. That wasn't enough to get me excited. But then it got a much better breakout there, okay? That still doesn't look like much, but look what happened next. Bang. See how that shot up? See there? A break, but that was meaningful enough. I knew this thing was going to take off. So we doubled down on the bank stocks and said, okay, the yields are going up. The yield curve is going to steepen more. Sure enough, it did. And we were able to not only, we were able to double down a position we had already taken in some of those, in a lot of those financial names and those ETFs. So you can see how that can really, we had the fundamental story that we all know that higher interest rates, especially the yield curve, when long-term interest rates move above short-term interest rates, they can make a better profit because they're loaning out at the high rate and taking money in at the low rate. That's net interest margins, as we hear about, NIMs, net interest margins. As the yield curve widens, they make more money. So that was the fundamental story. And then we got the breakout above the key trend line, and it already made a higher high. And we knew, boy, this thing's really going to go. Interest rates are going much higher. A lot of people didn't agree with us, especially back in September, and it worked out very, very well. And of course, one of the things, again, we talk about momentum. Key to momentum investing is seeing a series of higher highs and higher lows, or on the downside of lower highs and lower lows. And whenever you see that continue, it's a green light. Okay, it's continuing higher highs. We have a long position. We like the stock. We thought it started at 50. Now it's at 100. We've doubled our money, but man, it still looks great. The fundamentals are still improving. Our price target was $100, but it's gotten there. The situation has changed. It's even better now. We're going to stick with it. Maybe we sell a little bit, or maybe we sell half and take. That means we have 100% profit going forward. But the whole thing is that it can be. It's just a good sign of continuation. However, when you suddenly, if you've been making a lot of higher highs and higher lows, and then you make a lower low, that's a big warning flag. Just the opposite, when something has been making a lot of lower lows and lower highs, and it breaks to a higher high, that's a very bullish sign. And this is what we're doing right now with Darden Restaurants. Obviously, it got killed like all the restaurants did during the pandemic. It's been a nice run for us. Now here, and again, this was actually a little over a month ago, but it's now breaking down below that thing. So I have a big yellow flag. It's only slightly below it, but we got to be a little bit careful because everything's reopening. You think, oh, geez, fundamentally, the restaurants are going to do great. But the chart is now telling us there's something to be worried about because most of that stuff is already priced in. We'll have to see a little bit more confirmation on that one before I raise a yellow flag on the restaurants. But something always, again, you have to be careful because things get priced in a lot quicker than the actual reality, and that's what gives us the opportunities to make some, go against the crowd and make some money. A couple other things here. I don't want to go too long here. We still got some time here, but plenty of time because I want to leave time for questions. But relative strength index, and you probably hear this a lot on the financial news networks, RSI, relative strength index, and it's just a measurement of momentum, but not only that, is the strength of the momentum. And sometimes things get too high. For instance, the RSI chart, the 70 level means it's getting overbought usually, and the 30 level is getting oversold. In fact, and I'll show you in a second, there's a red line at the 70 level. That means stop buying. And there's a green line at the 30 level, means it's getting oversold. Go ahead, go, buy. And I look at both the daily and weekly charts. And this can be very, very helpful. Again, when the fundamentals look really good on the upside or really bad on the downside, it doesn't mean that a lousy stock can't have a serious bounce. You can take advantage of it, and active traders can take advantage of it over a short-term basis, especially in the options market. So that's why we look at things like this all the time. Now, this is one of the best examples we had here in Viacom. My tier 2 pick, I took it on the tier 3 call. I made it a call. I said we got to short this stock. It was ridiculous. Look at it. Look how overbought. It got overbought here. It got overbought here. It got overbought here. Look how much more overbought this was. 70, just all it takes is usually a little move above 70. It got to almost 100. I mean, it was ridiculous. I was just like, I've never seen this. This is not, when Tesla gets to 90, that's really scary. Viacom, they're not changing the world anytime soon. They're not coming up with a vaccine anytime soon. This stock is ridiculous. I said, buy puts. The specific puts we talked about. In 2 days, we made 2,500%. 2,500% in just 2 days in those options. And of course, the stock dropped 60%. So those who shorted the stock made 60% on their money in just 2 days. Now it's funny because it's now since then, now this is what happened earlier this year. The stock has flattened out since then, gone down a little bit more. And we've actually now have it on the buy side on a longer term basis. We're not looking for the quick trade on a longer term basis. So that's how this RSI. And look at Tesla. Going back a couple of years ago, back in June of this year, it got ridiculously oversold. I was pounding the table, saying you got to buy this stock, even if you think Tesla is a complete fraud, which it's not. But if you think it's going to zero, which some people did at the time, I said this thing has got to rally. We stayed with it from here below 40 all the way up to $600. Again, using technical analysis because fundamental analysis on Tesla is tough because it's such a long-term feeling. There's nothing wrong with the story, but it's a long-term story, not a short-term one. So that's when technical analysis is vitally important. One last one, I'll just go very quickly, is the MACD cross, the moving average convergence divergence oscillator. And it's just one of these things where you have, instead of, I'm sure a lot of you have heard about the golden crosses and death crosses. That's when the 50-day moving average crosses above the 200-day moving average. That's a golden cross, that's bullish. And of course, the death cross is just the opposite. And this is the same thing with only shorter term. It's the 9-day versus 12-day. And it gives us an idea when we're seeing a short-term move. I'll have some charts later on that we can show where the MACD can be very, very helpful. And so we'll be looking at that. But again, it's just another one of those ones. And again, we could talk about head and shoulders patterns and triangles and ascending triangles. It would take too long. But to just give you an idea of what some of the basic stuff is, it could be very, very helpful. And you don't have to be a super, technician to spend hours passing the CMT test to use these to your advantage. And there's a couple other things is sentiment readings. We see that the II poll, the AAII poll, which is about the individual investors, and if they get too bullish, that's usually a negative sign. It means that everybody's in the market. Same thing with if they get too bearish. But we also look at the DSI. It's the Daily Sentiment Index poll. That is actually polls actual traders, futures traders. And it gives us an idea, not just on the S&P, on the bond market, but on commodities, oil markets, the VIX, all these other issues. When it becomes very extreme, it tells us that there's nobody. If everybody's extremely bullish, there's nobody left to buy. Extremely bearish, nobody left to sell. And it's usually a good inflection point, especially on a short-term basis. And then finally is the commitment of traders data, COT, which is the actual positions that not just the sentiment, but the positions that these futures traders are holding. And again, same thing, when they become extreme, they're great contrarian indicators. And they've helped me make some really good calls. That was part of the reason why I made that big call last late August and early September on interest rates, saying that they had to go because everybody was on one side of the boat. Everybody was short the bond market. In other words, shorting at price. And if the price went down, that meant yields. I'm sorry, take it back. It was just the opposite. They were very, very long. In other words, they expected the price to go down. Price to go up and yields to go down. They expected yields to go a lot lower. Remember, there was 0.5%. They thought they could go to zero or even negative. I was saying, no, everybody is loaded to the gills. There's nobody left to buy. They can't go any, this price can't go any higher, which means the yield can't go any lower. It's got to change. This has got to change and will not take a small amount of time. And it didn't. Rates have been going up ever since. Long before anybody was talking about inflation. That was the call to make. And most people weren't making that call until this year, several months later. Okay, let's put it together in some of these situations, and then we'll get you some questions and answers. I have way more charts than I will go through because I want to give you guys plenty of time to do some Q&A. But let's go. Whoops. Okay, good. Here, Invesco. This is one a call here where I love the story on Invesco. They're great. There used to be a company that focused primarily on technology stocks. That hurt them badly after the tech crash. They became much more diversified, so I like that. I was turning more bullish on the on this company also because we saw that there was a lot of these companies were being looked at for takeover plays by the really big asset managers because they're the asset, the Morgan Stanleys, the JP Morgan Asset Management. These guys were looking to buy it, and Invesco seemed to be a great opportunity. So that I liked on a fundamental basis. Number two, I like the fact that I was looking for interest rates to move higher. That's going to help their net interest margins as well. And then we got the nice breakout on a technical basis. So I love the fundamentals. On a technical basis, the stock broke out not only above its 200-day moving average, so we had a moving average, but also a nice sideways range. Whenever something trades on a range especially for extended period of time, whenever it breaks out of that range, whichever way it breaks out of that range, it's usually a big move. And this is when we added the stock right here. It broke out and it's been going up ever since. So it's worked out really, really well. And we continue to love this stock. Now there's another one here, a Microvision, which is one of our best ones. We made over 400% in this name. Here's a stock. We're on our tier one. We went and bought it at $2.68 down here. Okay. Again, we love the idea on a fundamental basis. Number one, they have this new display that for smart glasses. Everybody's saying, oh, smart glasses, that's never going to work. Well, Tim Cook's saying it's going to be the next big thing. And these guys have the display that will actually be able to put it in just regular glasses, fashionable glasses. Most of those glasses look like some sci-fi movie from the 1950s. They were all ridiculous. It just, everybody thought it's disappeared. This is never going to work. A lot of people do think it's going to work. I like that. And because of this new technology from Microvision. But much more importantly is their LiDAR technology. LiDAR, laser radar. Okay. And that's how these driverless cars can work. They have these little radar situations, these lasers that punch out. So it's the only way you can work. And it's not just for those. Those are for vacuum cleaners and robots. And you're not, if you, in the future, when we have waitresses and waiters, there's just going to be robots. So they're going to have to use that LiDAR thing to get around. This is very good. And a note that Elon Musk, one of his most senior people in his company, just a few weeks ago left because Tesla doesn't use LiDAR technology. One of their most senior people left to join a LiDAR startup because he believes that that's the way to go. And when a guy, Tesla is doing that, it makes sense to us. But anyway, so this has worked very well. The stock's up over 400%. But in our tier 3 thing, we've been able to use technical analysis. Okay, now I bought the stock here because it broke out of its highs. I say I've been high in here. It made a new higher high. So I bought it there. That's where we picked it, okay? Then it got ridiculously overbought. We looked at its RSI chart. Just literally a couple weeks later, the stock was up 400% in just a couple of weeks. And I'm like, whoa. This is out of control. It's RSI stock. So I said, I like it long-term. Let's sell half our position. And that's what we did. Then it got down to here. And I said, okay, let's buy that back because I still love the story. And it gets down to $5, we'll buy it. Sure enough, it got there. We bought it all the way up to here. Now, the only way I could draw this chart was because it would go there. I actually did say sell a little before the high. It didn't get quite all the way up that high before we sold it, but it worked out very well. Again, I said sell half. The guy said gets down below 15. We'll look at it again. We bought half of that half. In other words, we went from 50 up here, went from 100% to 50% position. Here we went from 50% to 75, and then we went here again to 70 to 100%. And then again, you can see the stock didn't get as quite overbought. I wasn't as aggressive. I wish I had been more aggressive. But the point is, the stock's up over 400%. But the way we've been able to trade around it has enabled us to make over 1,000% on the stock, in less than a year. So it's again, it's a way to use all these different issues. Like I said, I'd say one last thing, and Viacom, I already talked about that. Okay, two more things I'm just going to talk about. Manpower, just because it's a more recent call that I made just 5 weeks ago. And here was a situation where I mentioned the MACD chart. Well, I saw that every time we saw a positive break, see a positive breakout there, and it went up, positive cross there, the stock moved up nicely. So I got into it here as another positive break. And so I said, let's buy the stock here. Then it made a nice higher high, so we doubled down on the stock. Now,
actually, never mind, Matt. Sorry, keep going.
Okay, so I just the point is, they say, well, why did you turn bearish for the negative cross? I said, well, the last 2 times it's crossed, it's actually just been flat. The positive cross are for this particular stock. The positive cross are good. The negative cross aren't really that bad. See, negative there, and it really didn't get clobbered. Negative there, it still went sideways. Negative here, and it's still going sideways. So I'm not that worried. If it breaks down below 120, then we'll take our profits. So we have a nice stop level, a nice profit there. But the point is, we're using fundamentals and technicals. The last thing, again, we could go on and we could just Tesla. If you guys want to talk about that, I'd love to. But just one other thing is just going back to what we said about the energy stocks and using the work that I use. I turn bullish here. Okay. Now this is the XLE, which is this is the XOP, the energy oil and gas ETF. Now I turned bullish and the thing went up. Well, then it came back down. Actually went a little below, but not much below our level. So I still feel confident because I love the fundamentals. Then it took off. Okay. And look at this thing is up. Even now it's up over 115% since we turned bullish. All right. The bulge bracket firms, they didn't turn bullish. Morgan Stanley and Goldman Sachs, they turned bullish just after the first of the year. That's great, but they missed a 50% move. Last week, Schwab and BMO, the old Bank of Montreal, they turned bullish just as I led. The XLE is up 85%. This XOP, the XLE is the broad energy stock ETF. The XOP, the oil and gas ETF, I mean, so one's up 85, the other one's up 115. Look how much they missed. It's just the Main Street, Wall Street is great, but they're paid to be bullish, and they're not, and they're paid not to take big risks, and they just missed a great move there. So again, just to talk about some of our big moves we've had, these are the sums on our Microvision, which we just highlighted. It's up 400% right now. Blockchain Riot, we've already sold that one, but you can see these are all my newsletters less than a year old. So all of these are less than a year old. Now I just want to highlight that Walgreens up 47%. That's not my 5th best pick. I just highlight that because it's not a sexy stock. It's not a big tech stock. It's just a drugstore. Okay. And yet if you get it at the right time, when it gets oversold, you can still pick stocks like this and make a lot of money. And just because everybody wants to know, what have you done for me lately? Manpower Group, we paid just a couple of weeks ago, and it's already up 22%. So in other words, it's not just the picks I made last year that have worked well, the ones that this year as well. And then finally on the tier 3 picks. And again, this one involves much shorter term. I do a call 3 times a week for about 20 minutes or so, talking about shorter term opportunities, and in some cases where we can do the options. And I mentioned the Viacom, we had very well. Wells Fargo, this one happened to do because I saw a huge amount of buying in the call options in big blocks, which they knew something. Just in the last couple of weeks, went negative on Seagate and negative on Seagate because it became ridiculously overbought. It got about as overbought as Viacom did. So we bought the put options in that up 400%. And it actually, we lost a little money for a day or two, but not much. And then we stayed with it, and it rolled back over and made 400% in about a week. Ford Motor, we did this simply because we saw a huge amount of block buying so somebody knew something. Somebody knew their earnings weren't going to be good and were buying puts. So we went in, and sure enough, 370% in just about a week or so. And here's some of the other ones too, where we've had some other good calls, both calls and put options on a short-term basis that have worked out really well. Again, using both fundamental and technical analysis combined to kind of get these kind of returns. That's really what I have. I went longer than I wanted to, but I hope it give you an idea of why, how I'm very, I love the markets. I'm very passionate about the markets. And, I sit there, if people laugh in my offices because I yell at the TV all the time because see some of these kind of mainstream people talk on CNBC and Bloomberg and these others. And I talk and say, you're crazy. You're just following the typical consensus view. And that's fine. You can do pretty well with that. And that's where you want the tier one kind of thing. But for the other ones, you're really to maximize your profits. You got to look beyond the fundamentals, look beyond what the consensus is thinking, and you can really work out really well.
All right, great stuff. Guys, any tickers that you want Matt to look at? As I said before, welcome to look at some cryptocurrency as well. Steven. Looks like the first one, but this one's been asked a few times. NEO. Let's go ahead and look at NEO and Tesla right off the giddy up.
Okay, well, something here. I'm going to go.
And then while you're doing that, while you're setting that up, Matt, so Jasmine has a question about RSI. If the stock is less than 30%, then it is being oversold. That's correct, right? And
correct.
then that is that a good sign to buy?
Oops. Yes, that is a good time. That is a good time to buy the stock. But you also want to be, always look back on an RSI chart and see where that individual stock is traded. For instance, in Tesla, you get down to below that 30 level. It has been. Can you see the Tesla chart? I have it up there now. Hope you can see that.
Wait. So, are you trying to show Bloomberg right now?
Yeah,
no, you're the presentation. Yeah, we can see it. Just
okay,
go ahead and hit present though, so it's
let me
big
do
enough
that
for everyone.
Sorry, because I escaped it. Okay, there we go. And it just takes a second to load. It'll be right there. There we go. Okay, but see how for Tesla, okay.
Oh wow.
You see, it got down there, it got there. So it's right at this level. Now it did get a little bit more oversold back in March of last year, but of course everything was getting crushed back then. But the thing is, some stocks, some things are even more volatile than, for instance, your cryptocurrency. You look at better, okay? For this one, we know. Just look at if you look back several years, this tells us that yes, below 30 tells us it's a good opportunity to buy. However, we can see because of all the enthusiasm, it usually takes a big move, a much bigger move than just 70, all right, to get it to where it's an overbought condition. So again, just go back and see what has that 30 level been for that specific stock or the ETF, and see that. So, geez, this one, it always has to get into the mid 20s before it gets oversold. So maybe I'll nibble a little bit on it here, but I'm really going to get more aggressive if it gets down to the 25 level. And same thing here. You're not going to sell. See how it is here. If you sold right here, it was getting kind of overbought. Well, look what happened. Stock kept going up. So you got to make sure you look at it past. But 70, you want to sell. Above 70, you want to sell. Below 30, you want to buy. But you always want to look and see what this specific stock is playing off of.
Yeah, I love that point. So people that have been in the markets for a while, I'm not trying to date you, Matt, but have been seeing certain assets. How many years do you think you've been looking at SPY on charts? Matt, are you frozen or am I frozen? Hey guys, give me a 1 in chat if Neil is frozen. Give me a 2 in chat if Matt is frozen. No. Okay, so while Matt figures that out, I'll text him right now. While he figures that out, consider me your substitute teacher. So if you guys have some questions, I'm not going to pull up any charts, but if you have questions about concepts like RSI, about these moving averages, about that sort of stuff, I can answer. Oh, Matt's back.
Great. Sorry about that. I don't know what happened. We just kind of got. So what were you? Where are we now? I'm going to.
So I was just asking you. What I was doing was just reinforcing this point that you made that 30 is under 30 is oversold on RSI. Above 70 is overbought on RSI. But different stocks, different ETFs, different assets have different personalities, and some of them can get all the way up to 85 before it's really overbought, before something happens. And I was just trying to point out that Matt, you've been probably looking at SPY on charts for decades.
Oh, absolutely.
So you have an intimate awareness of what levels you need to get to on the RSI before you start actually paying attention to it. For newer traders, simply just looking at overbought, oversold, 30, 70 isn't enough. You really want to, you guys, you really want to look at the individual assets and then look back over time, over on the daily chart or the weekly chart, and really look at how the stock has behaved when it's hit those levels, and find what the threshold is on each one.
Right, exactly. And just to talk about this chart in particular, I mean, it's such a key level. The next few days are going to be so important in the stock. I think it's probably going to bounce. But I mean, again, if you're going to be an options player here and you want to play at it, it's like, great. You could buy both. You could do a spread, buy both a call and a put, because this thing is wound tight. It's going to either rally, almost certainly either going to rally really strong or fall really bad. If it breaks below this line, it's already below, got slightly below its 200-day moving average. The last time it got to that level, it held. But again, here, it only got slightly below, so that's okay. And it didn't make a lower low below its lows from March. My feeling is because it's reached a level that usually bounces in terms of its RSI, I think it's probably going to go higher here, and you'll make a lot more money on the call than you'll lose on the put. And in fact, you'll cancel out your put. You'll definitely lose some money, but you should be able to make 2 or 3 times your money here, and you lose 50% there. You'll make 300% versus 50%. It's a nice play. And the reason why I say I want to buy both is because if I'm wrong and it breaks down below this level, that's going to be an incredibly important lower low. And those who have been holding on to the stock, momentum players who've been holding on for now, are just going to say, okay, that's it, I'm out. So kind of a key level. Next week, see how this thing trades. But if you want to buy that spread, and if you want to go long the stock and you're like, I'm just not comfortable enough in options yet, well, you just know that right now you use that. It's trading at that low right here, which is 563. It gets below that level on a percentage basis. It's not a big loss. You're going to get losses. Okay. I don't care if it's short-term, long-term, everybody in the world take losses. You're going to get them. The key is to minimize those losses, not take the big ones. So if it breaks below that 563 level, then you want to say, okay, I'm going to get out. And you may even want to get out and do some make some bets, buy some puts or short the stock, and you completely reverse it. But again, since it's getting so oversold, I think this thing could really take off. So that answers your question on the Tesla.
Yeah, and that level for your green horizontal line, I just put this in chat, but I wanted to make sure that, did I say 560? That's about 563. That green support line.
Right. Yes. 563, and that's and key. And the other thing I just want to let too, especially in a stock like Tesla, which, because it's a $500 stock, it can see wild on at least, if it moves 20 points, it's not that big a percentage point. If if U.S. Steel trades 20 points, it's a huge move. But my point is that you usually like to look at a closing basis. This chart is not a closing basis chart, but that's what the close was. If it gets below, you got to be very nervous early in the day. But especially if at the end of the day, that's when it's like, this thing is trading at 550. It ain't gonna make it back to 563 in the next half hour. I'm gonna go ahead and sell the stock.
So Matt, if I wanted to just go long, just buying common stock on Tesla, because I believe that it's going to bounce off of that 200 daily moving average, what would be a nice stop loss to put in place for that trade?
I'm gonna put it at, again, you can give it a little bit below that 563 level, but
is there a percentage that you might say, or maybe I
go 2% at the most.
Okay, got it. So 2% under that line, and that's nice and tight. That makes a lot of sense.
Right. And and so and you're out and you move on, and believe me, sometimes you get stopped out, and then it bounces. It's like, oh my God, I blew it. But 2% is usually a good play. And again, you're going to have some times where you sell too early, but nobody ever lost money taking profits. But I think this thing could easily, it could easily trade to 700, and 800 is highly likely in my opinion. But yeah.
Okay, and then Daryl, you said you weren't getting any love. So if you had a question that we missed, go ahead and drop it again. I'll try to get to it. So how do you determine your stop loss?
Stop loss in 2 ways. Number one, I try to keep it definitely no more than 10%. 10%, you're out. Okay. Again, If it's something you really believe in, it goes to 11%. Okay, that's fine. But you want to keep anything to 10%. The other thing, though, is that usually I try to keep it to in the 7 to 8% range. And it doesn't mean it's not going to work eventually, but I get out before then. And sometimes I get out. I've had Pfizer. Pfizer was up 1%, and they announced that they came up with this new vaccine. I'm like, oh my God, this is going to be a huge winner. The stock did nothing. Why did the stock do nothing? Well, guess what? Even though they announced a really good thing, the CEO also announced that when the stock popped, he sold 60% of his holdings. 60%. Okay, he didn't sell just a little bit. I was like, what? He knew something about the way the stock, something about the stock, and sure enough, it's been dead money ever since. So there's one where it wasn't even a stop loss; it was a stop gain, but it was only 1%. Could somebody try to take care of my dog there? That'd be great. Sorry. So but the thing is 5 to 6%. However, if the stock rallies significantly, you want to leave yourself more room. And so unless, for instance, that Microvision is up 400%, 400% in 6 months. So if it drops 20%, that's not a big decline because the stock has come down so much, because it was rallied so much. It would make sense when a stock rallies that fast, it could 10%, 10% is no big deal. So what you do is you raise your stop out level to ensure that you keep a profit, but you give yourself more leeway because you already have so much of a gain. And then again, it can change again if it's like, ooh, okay, now I think it's fully priced in and based on the fundamentals. So, maybe a few suckers will keep buying it. So I'll raise my stop to 5% loss. So it can move around. But when you first initially put it on, I'm kind of looking 7 to 8%, and you get out no more than 10%. But make sure to raise that stop loss. Again, it's no longer a stop loss. It becomes just a stop because you're ensuring yourself a profit. But let it go up because you don't want to be. There's nothing worse than having a stock go up 50% in a couple of weeks, and 2 months later it's back to flat, and you're like, oh, I missed the move. I didn't take the profits when I should have.
Absolutely. And since we've been getting at it a lot, let's take a look at NIO, another EV stock.
Okay. Now, can you see my screen?
Yeah, we can see it. And to answer this question, Sun, which tools do you use to perform analysis and visualize stocks? Matt is using the Bloomberg Terminal. That's the. Go ahead and look up the price for that. Yeah. It's too expensive. I'll just
$3,500 a month. So that's Miller Tabak pays for that. So I'm
right. So okay. So let's take a look at NIO here. Right now you got Ethereum open though. Yeah, interesting.
You want to do that first, or you want to? We can just do.
Let's do NIO so they don't come.
We can go back to it. We can go back. Yeah.
Egg my house.
I think it's rotating a little bit there. Okay. Now, this is a very, very key time for this stock. I was looking at it earlier because I do get a look at the stock's getting oversold, right? See what happened last time it got this oversold. It bounced. I mean, not a lot, but if you on a short-term play, you made a very nice return, especially if you bought the options. But okay, I'm going to get some of these things out of the way. I apologize. I have too many moving averages there. Let's get rid of some of them. Okay. Let me put that 50-day back in there. Now, look at it. We're looking at people say, oh my gosh, we're getting close to a death cross. The thing is, though, is that a death cross really means when the 50-day crosses below the 200-day and both are declining. NIO's 200-day is still rising. So if it crosses here, it won't be an official death cross. So I'm not as worried about that as I would otherwise be. But here, there we go. You see how it's testing. It looks like it wants to hold that low in March. And again, getting oversold. So here's one where I sit there and go, okay, if I buy it here, it breaks above its, I buy it here. I got to stop at its lows. I'm going to go again. I'm going to use a 7 to 8% stop, maybe 10% at the most. Okay, and then you get out of the stock. You're at 31, basically at $32. Okay, but if it breaks above its 200-day moving average, look at the 200-day moving average. Okay, it held it. It broke it, but it didn't break. It didn't get the double break. So if it breaks back above that, I think it's going to run and move above these levels. It could be a real nice run. So we're at a key technical juncture. This is another one. If you want to do in the options market, you can do a spread, buy the puts and buy the calls. I think it's going to rally here again because it's oversold. Let's go back a little bit further. If I can, one second. See, now here you say, oh my gosh, it got really, really deep in these years. But this was a time when Tesla was all over the place, right? And these things, even though it doesn't look like much on a percentage basis, these were huge, huge moves. But more recently, these levels here, here, and here have been great levels to buy the stock. Again, though, I'm going to say the reason why you want to get out of this, you want to get out of this below 32 because if it breaks that level, that's a descending triangle pattern, which we didn't talk about, but it will give it another key lower low. And boy, again, the momentum guys who bought it here thinking it was gonna break out. You see it got a minor higher high. It's let's bring it in here.
Yeah, looks like a failed breakout.
Yeah. So you got to be very careful here, but it's one that I would want to play on both sides. But again, because it's oversold, I'm definitely leaning more to the bullish side of things.
Excellent. Okay, so just going off the list here, let's hit Amazon. That's the most recent one.
Okay. Of course, Amazon is such a great company, but that doesn't always mean it's great stock, and it's certainly seen some incredible corrections. As I said earlier, I mean, it's seen. Let me just. I'm going to go back a few years so we can look at this thing. But look at that range it's been in, right? Let's get rid of. Bang. I don't want to take too much time, but see, it had this huge rally, but it's been dead money. And the reason, again, these portfolio managers okay, it's a little off, but see on this range here, it's been in that range, that sideways range for a while. It's right in the middle of it right now. So which way is it going to go? I don't know, but it's been dead money for a while. If this stock goes down further, at some point, the big portfolio managers, I mean, this is a huge holding. They've pared back some of the holdings, but it's a huge holding in all these mutual funds. You have to own Amazon, but they don't have to be overweight the stock. And they could go to an equal weight. At some point, this stock has done nothing this year, but your energy stocks have done well, and they're all very underweighted, their energy stocks. What are they going to do? It's like, as much as I love Amazon on a long-term basis, I'm still measured year to year. We're 5 months into this year, and this stock is a drag on my portfolio. I'm not going to sell it all. I'm not going to sell a huge portion of it, but I do have to sell some because I got to get into the stocks that are outperforming. And so I'm really worried about the stock. The fact that it's close to oversold than anything. It's in the middle of the range. It's kind of neutral here. The 200-day moving average hasn't been that important for the stock. You go back a couple of years, it's broken. It's dropped well below it, well above it, but not really done much after that. So, I mean, to be honest with you, it's a great long-term play, no question about it. The other thing I'm just going to say real briefly, and it says not something about the company. It says something about what they think about interest rates. They sold $40 billion worth of bonds this week, okay? And when insiders sell shares, that always worries me. They're not selling the shares, although Jeff Bezos has increased his sales of Amazon. That concerns me. But they are brilliant. They're not just good at retail. They are good at everything, finance, the whole thing. They're the smartest guys in the room. They went out and they flat out said, we have no use for this money. We're just going to raise it because interest rates are so low. Okay. You wouldn't do that because you still have to pay you have to pay the interest on it, even though the interest is low. You wouldn't do that if you thought interest rates were going to stay the same or go down. Only reason you would do that if you have no use for the money is because you think we want the money later and interest rates are going to be much higher and it's going to be much more costly for us to borrow that money in the bond market. So these are the smartest guys in the room. It's a neutral play. Jeff Bezos has accelerated his sales. I want to wait to see until it breaks above, it's that range of 3,500, 3,000. It breaks below there. I'm going to take, it's such a great company. I hate to say that, but it's been dead money for a while, and until it breaks above 3,500, it's going to remain that way. And from what we're seeing, from what the moves they're making, both Jeff Bezos and then a corporate side, higher interest rates are not going to be good for this for the stock market overall, and that worries me.
This is a great. I think this epitomizes what this whole session is about, which is fundamental versus technical analysis. The fundamental being what is the business's performance, what's happening with the business, and then technical analysis, what's happening with the stock, what's happening with the stock price. Completely different things. You have a great company, not a great stock.
Right.
You can have a you can have a bad company and have a great stock.
Absolutely. Absolutely.
Okay, so we're getting we're over on time. So what I'm going to say is I'll get one more ticker in. And I want to make sure, guys, because there are a lot of stocks coming in here. I'm happy to stick around afterward. A lot of the stocks that I'm seeing, I'll be honest, are much better for day trading, which I mean this in the nicest way possible. If you're watching this right now, you shouldn't be messing with those stocks. You should be worrying. You should be dealing with stronger stocks that are actually going to make you money, not make you win the lottery. So I'm gonna try to grab one that's got a little more strength behind it. Um, let's look at Valet. VALE. And this one I actually don't know about, so I'm interested to see what happens. Oh, you know what's even better? Let's hit AMD. Let's hit AMD, and then if we have time, we can do Valet. Because AMD, you can day trade, you can swing trade, you can invest. You can do all three with this. It's a very good stock for all applications.
Okay. This is at such an incredible inflection point. These chip stocks bounced late in the week, but let me just. Again, I'm sorry I have so many. I'm going to get rid of some of these. First of all, we have a death. Well, again, it's not a death cross because the 200-day moving average is rising, but it's still a concern. It's still a concern when you see that. But look at that. It's kind of been riding its 200-day moving average for a while. And look back here. It provided very good support right in here in March of last year. And then June didn't quite get to it, but you see how it hasn't been below that line for quite some time. So that's a concern. Okay, it's starting to break meaningfully. It's no longer riding that 200-day moving average. That's a big concern. It's oversold, but not extremely so. And look at this. Boom. See this? It's breaking, so it needs to hold this line. This is, 1, 2, 3, 4. This is the fifth time it's down to this level here of basically 74.50. And next week, it's going to be very important. If it breaks below that level, especially if it breaks below the lows, the intraday lows, which was about, let's see here, 72.50. You break below that, and we got problems in this stock. That's going to be, it's more of a sideways range. It's a great company. I mean, Jim Cramer talks about this all the time. I think he's in love with the CEO who she's fat. She is unbelievable, but she's fabulous. But if this breaks down here, a lot of people are going to throw in the towel on the and we see, and I see Taiwan Semiconductor, which is of course nowadays is like the only one who actually makes semiconductors anymore. I had dinner last night with a senior guy at Intel. It was a social thing, but Taiwan. So if you break down here, same thing. They're by far the biggest holding in the semiconductor index, the semiconductor ETF. If you break below that, this is. I'm talking too fast. I'm sorry, but again, you get below 108.50. You got again. That's going to be a key lower low in the most important ETF. I'm sorry, the most important stock in that group. And in fact, again, we didn't talk about the triangles, but that is a classic descending triangle pattern. You break below that, and it's all the momentum players are going to dump the stock. They're going to dump the group too, which the SMH, which is trying to hold support. If it holds and bounce further, it's going to be great. So it's going to be critical for how stock is going. So in other words, don't be afraid to miss if you like it on a fundamental basis. Don't be afraid to miss the next 50 cents or $1, because you want to have that confirmation that it's actually going to rally from this level. In fact, I don't know that I'd look at it until it got above 120, but it breaks down here, and I'm worried about the semiconductor stocks right now. It's just there's a lot of reasons to like it because they're the shortage, and they have so many. They have such pricing strength because there's such a shortage. The problem is if you don't have the product, it doesn't matter what the prices are. If you have nothing to sell, you can't make any money. And these stocks have been disappointing in the last couple of months.
Matt, let's end on a larger note. So I think we're there. I understandably there's some confusion because we're getting in the mainstream media, it's just the media in general, guys. We're getting reporting that the stock market is growing, as it has been. If you look at SPY and especially the Dow Jones for the majority of 2021. But folks are looking at these picks that you have here, and most of them are kind of sideways. They're not on any tremendous, from a momentum perspective, nothing's on a tremendous run right now, that at least that we've gone over. So folks are asking, why is it that we're reporting that the stock market is growing when we see so much sideways action? Can you sort of delineate the price behavior there?
I hate to say it, I don't want to, it's just
Here we
it's not
go.
the press, but the press and the and especially the mainstream Wall Street. I mean, they're paid to be bullish. That's just what it is. I'm not saying so much the press, the financial press, but they get these guys on from the big brokerage firms, Merrill Lynch's of the world, and they come on, and most of them are bullish because that's what they're paid to be. And there was one time a guy from a very, very, very large firm was the strategist there, and it is a very good friend of mine, a customer, said that this is going back a few years. He said he gave us this big bullish. He'd been in the offices of this institution, and they said, "What, geez, you came up with such a bullish presentation, and I asked you some questions on the bearish side of things, and you agreed that I was right, and yet you still say you're super bullish." And he was asking this guy after the presentation, and there were just two of them left in the room. And he says, "I've been bearish before. He says, I've learned a long time ago is that it pays to be bullish. It pays a lot more. It's better for job security to be bullish and wrong than be bearish and right." And that's what they do. So that's why what I love about my firm lets me say whatever I want, and I certainly can say whatever I want in the newsletter. But there's going to be a correction at some point, and it may be starting now, but I think certainly by the end of the year, and we're going to be able to profit from that because we have the tools to do it, which we didn't have 20, 30 years ago. And so and then I will say this though, stock market usually rallies. It usually goes up. So that's another reason why it's smart for them to be bullish all the time.
Wow. Okay. So that that was a great insight.
But it's after so many years on Wall Street. But you're absolutely right. I mean, look at the trajectory has slowed down, and I don't want to keep you, but it's like, look at the stock market is trading at 21 times, 22 and a half times earnings. Okay. This trajectory is flattened out. We keep saying, oh, we got new highs. We got a million new highs. Well, yeah, but most of them are tiny, tiny, tiny new highs. Okay. Mm-hmm. And so it's flattened here. There's huge trajectory here, but it's flattened out. Now, again, it's still holding up. But at 22 times, I guess my point is that, gosh, there's so many great opportunities here, but it's going to be a stock pickers market and a group pickers market. The energy stocks, I think, are going higher. The bank stocks are going higher. Techs are going to have a little tougher time than they've had in the past, but there's going to be ones that do really well. But just think about it for a second. We're in the early innings of recovery, okay, of economic recovery. And usually when the early innings of a recovery, the stock market is very cheap. This time it's very expensive. 22 and a half times earnings, 3 times sales. Okay, that's very, very expensive. And the reason for that is that usually when we have a recession and a bear market or a big fall in the market, the Fed lowers interest rates a little bit and Congress provides a little bit of fiscal stimulus. This time, the Fed provided massive levels of stimulus, and Congress provided massive levels of fiscal stimulus. So monetary fiscal stimulus. So it has taken instead of being kind of moving up, the stock market always moves ahead of the economy. This time it shot ahead of the economy, and it's going to take a long time for the stock market to catch up. The fact that we're in early innings of the recovery means that the stock market shouldn't come crashing down. It would correct, may meet somewhere in the middle, but this thing will come up. So instead of buying the S&P and just sitting on an S&P or an index fund for the next 2 years, the market's probably going to kind of do choppy sideways, but different groups and different stocks will see big moves, and therefore active trading and here stock picking is going to be at a major premium, something we haven't had for quite a while.
Fantastic. That's a good note to end on, Matt. Thank you so much for all of your educational tidbits today.
Thank you. And good luck to everybody.
Yep. Thank you, guys. Is there anything that you'd like to say about your subscription service while you're still here?
Sure. Yeah. I mean, it's the one thing is that we have the again it's three different tiers, and I do put out the tier one is 2 picks every month, and those are again more long term 3 to 5 year thinking, and then we have the tier two pick, which is a little bit more. It's more in the well, I can say sometimes it's very short term, but it's really more in the 3 to 6 to 12 month time horizon when stocks get really oversold or really overbought. And then we have the tier three, which is involved where we talk about, we have a call 3 times a week, Monday, Wednesday, Friday, and we talk about our picks, the tier one and tier two picks, and also some other short-term opportunities. I showed on my presentation some of these options trades we've been able to take advantage of, and that's what we talk about. Again, we talk about options on our picks. Then there's some other ones that aren't on our official picks because they're much more short-term oriented. That call I made on Viacom where we made 2,500% on the options, that was a very short-term call, and it worked out incredibly well for us. But because it got ridiculously overbought, but the thing is that we talk about many different things and also talk about some macro stuff. And so on Monday, Wednesday, Friday, I do those calls, and we also send out a little note right after the call. It gives you a breakdown of kind of of what was talked about in that call. So if you don't have the time that day to sit there and listen to it for 20 minutes, you can at least get an idea of what was on it. And then on Tuesday and Thursday, Tuesday and Thursday, we send out, it's more of a macro piece, just talking about macro trends in the market. I'll still once in a while talk about specific stocks and show some charts there, but it's more of a macro call because those, of course, we always want to have an opinion on the macro view of the marketplace, and so there's a lot of different ways you can get involved, but it's I really think the next not just the next few months, the next few years are going to be unbelievable opportunities for those who are a little bit more active in their trading, and those something. I just want to read one last thing, Neil, and I know I'll get hop off here. Is that thing I talked earlier about when we say cut your losses and let your gains ride, but don't be afraid. I'm going to reiterate that thing. Don't be afraid to pay up for something you already own. Okay, if you like the story, it's again you're adding to a winning position. There's nothing wrong with that. And people like to add, oh, geez, I love this stock. And it keeps going down. They keep buying more. All you're doing is you're losing more money. And if you're buying on the way up, especially if you've locked in a real good chunk of that thing, you can't lose. You can just raise your stop. I just want to reiterate that. Be smart in your trading. It's a little counterintuitive. Most people say, oh, it's buy on weakness. Buy on strength. That's actually because it gives you that confirmation and that confidence that this idea, it was right when I called it. It's even more right now. I'm going to keep buying it on the way up. Don't be afraid to do
that. Great note to end on as we enter this new potentially bearish regime for a period. Matt, thank you so much for being with us on a Sunday.
Thank you. Have a great weekend, everybody.
Hey guys, I'm going to stick around, as is my custom, for 3 to 5 minutes to answer any questions you have specifically about the subscription, and if there's anything that's like very, very basic, I can answer your questions if it pertains to technical analysis. So Matt, you can go ahead and just exit Zoom. So guys, I'm going to drop the link in for you guys. I think it's been dropped recently, but I'll drop it in there one more time. Rodrigo's here. Rodrigo is, if you join us in the stock pick subscription with Matt Maley, all of the picks, the explanations why, the education, all of the research delivered to you in an easy to understand manner. Rodrigo will be a name that you know very well because he is our customer success manager. He's pretty much everything. So he's going to be someone to make you help make you as successful as possible, and he will answer any questions that you have. How soon would you be able to use the Elite subscription service? If you subscribe to Elite, you will start getting picks on, I think, Monday or Tuesday, like immediately. Once you get to the Elite level, you're getting 3 to 4 picks. You're getting more than that actually, because you're joining calls with Matt Maley during the week, strategy calls around lunchtime in the US, and that's where he's it's a lot. You'll find out a lot of opportunities. That's also where you'll get options picks. So how soon will you be able to use it? Tomorrow, for sure. There will be instructions for you to join that strategy session with Matt, and that's where you get more details on his picks that were on tier 1 and tier 2. You also get like very specific options. Like he'll if he sees something in the day and he says now's the time to do this thing, and then I'm going to take profit 1 hour later, that's where you get that. It's it's really cool. Is tier 3 mainly for options or also for stocks? It is for both. I would say everything about this, it's called Stock Picks for a reason. The subscription is called Benzinga Stock Picks with Matt Maley. It's all buying and selling stocks. But in the tier 3, he gives you opportunities to find more revenue, or not revenue, but more profit potential on your trades by throwing in options contracts on certain picks that he has. Like I wouldn't be like, so today he mentioned trading options on Tesla on Monday, based on where it's at, where it's like it's kind of it passed through the 200-day moving average a little bit, but he thinks that it could pop quite a lot, or it could go down quite a lot. We're waiting until Monday to see some confirmation. That's an example where on the strategy call at lunchtime, he's probably going to have some options picks for Tesla, and you only get that if you get the tier 3. You've got to, so in order to get to tier 3, you must buy tier 1 and tier 2 first, and then you get to tier 3. So they all go together. It's basically beginner, intermediate, advanced. They all go together. So if you're going to that page that I linked you to, you can go through the purchase process, and that's how you get through the tiers. You can't buy it individually. David, do we offer basic classes on how to buy options? Yes, we do. So the basics of buying options are available at Benzinga boot camps. We do those about once a month. I would highly recommend attending one of those, and we'll take you from 0 to hero on trading options. On the checkout page, do you have to put your credit card info in before tier 2 and 3 are available? Yes. You have to buy tier 1 before you see tier 2, and then you have to buy tier 2 before you see tier 3. The Benzinga Bootcamp, since you guys register, if you're registered for this, that means we have your email address. We will email you the details about the next bootcamp. And then also, I think on the checkout page for StockPicks, that's Matt Maley's subscription, you're gonna get it will say like there's a bonus that you'll get registered automatically for the next bootcamp. All the subscriptions here are annual. So this is 30% off for the webinar attendees. So that's you guys that are in Zoom. That's you guys that are on YouTube. It's 30% off for life. So it's normally $97 a year for tier 1. It's $67.90 for the entire year for life. It renews every year. You can cancel within 14 days, or you can cancel your renewal, whatever you want. We'll give you all your money back if you if you don't like it within the first 2 weeks. What is Matt's success rate? It's well above 50%, but I don't have the latest data. I just texted my coworker to get the latest win rate data and actual percentage gain. He's very performant and it's very good, but I don't want to give you a wrong number. But I can tell you that his gains are good, double digits, and then his win rate is above 50, which is that's right where you want to be a successful trader. Yeah, no problem. And then the stop losses that he gives are always like for him, 7%, a 7% stop loss is a big stop loss. Like he's usually keeping it a lot tighter than that. So the idea is that the most you can ever lose on any trade is 7% or less, and usually a lot less. Like when he was talking about Tesla, he was going in with a 2% stop loss. So if the trade idea doesn't work, you're out. That's it. If the trade idea works, then we're shooting for 25 to 50% on our trades here. And then if you're subscribed, you will get updates by text, by email if something else happens with a trade that he's currently in, and if something else happens, he'll notify you and say, hey, I think it's time to pile into this. And that's when you get the really big winners. So that's like, to answer the question about scaling into trades. Matt provides guidance for scaling in. There are indications as the stock is reaching its sell target, that it might even pass its sell target, or that it might just hit it sooner, and confidence has been increased. You'll get a notification that it's okay to scale in even more, or vice versa. If we're holding something and it activates and it's going well, and then there's some technical or fundamental indication that it's going to go poorly, you'll get an instant notification. Hey, it's time to close all of this. I don't like the way it looks. And he'll even do that for stuff that he hasn't pointed out, like uh, he pointed out that Ethereum was getting really overbought like a couple months ago, and it wasn't even like one of his picks. He was just notifying subscribers like, "Hey, this thing is looking like it's going to take a dip," and then it took a dip after that. No, this doesn't come with Benzinga Pro. We haven't packaged these together yet, so you got to buy them separately. They're two different things. Is there a cost for the boot camp? Uh, Sometimes there is. If you register early enough for the boot camps, it's always free, and then when we get close to the event, we start charging for tickets. But that's if you don't get in on time. If you purchase Matt's stock picks, you get pre-registered for every boot camp. We try to do them every month. The only time that we wouldn't do a boot camp any given month is if we have something special. Like recently, we had our small cap event, which is just specifically focused on like fundamentals with interviews with like small cap or penny stock, whatever you want to call them, CEOs. So that was kind of a special thing, which we will do. Let me get you the total cost. Get a notepad out. I'm gonna break down the pricing for the first three tiers. And I think Matt was a little bit hesitant to get into the new tier 4, which is going to be the 24/7 chat room, because we haven't started that yet. So we're kind of we're testing it out. We're gonna let some folks in there, see how it goes, and then make a broader launch on that. So that would be a tier 4. But right now, we're just looking at the first three tiers. And right now I'm working out all of the pricing so that you guys can read it very easily. And I'm going to paste it into Zoom chat and YouTube chat. Unless Rodrigo, if you're still here, if you already have that ready, let me know. Otherwise, I'm getting it ready. I'm almost done. Is there a cost for the boot camp? What's the end total cost? Any more questions? Thanks, Matt and Nick. You're welcome. You're welcome. Thank you for being here. Almost ready. All right, here's the pricing for the first three tiers. All together here for you. Oh, Rodrigo beat me to it. All right, all right. There you go. There you go. There you go. Rodrigo rules. Um, how does Bloomberg compare with Thinkorswim? Bloomberg costs like 30 grand a year to subscribe to. Thinkorswim is free. All you can see is a logo. Yeah, it's a bootcamp logo. It's a nice logo. Yeah, yeah, exactly. Rodrigo just pointed out Bloomberg is you have to be approved for it. It's mostly for equity firms. It's for licensed, usually professional traders. It's not for retail traders. You're welcome. You're welcome. All right, guys. Any other questions about the subscription while I'm still here? Oh, what's the difference between the tiers? So let me. So I'm gonna break it down. So if you get all 3 tiers, you get 18 picks minimum per month, which I'm telling you, I'm telling you that's like almost too many. So you're gonna like you're getting plenty of value. The difference is the number of picks. So the more tiers that you add, the more picks you're getting. And then on tier 3, instead of just getting emails and SMS alerts about picks, you're joining calls with Matt. We call them strategy sessions. So I've just posted in Zoom. So like they're 30% off. Each level is 30% off. So I posted like the previous price and then the now price. Those are the prices for you guys because you decided to hang out with us on a Sunday and invest in your education. Max, the boot camps are a full day, and you can just pop in and out whenever you want. It's a full day of education. It covers everything. You reach tier 2 and tier 3 after you get tier 1. You have to buy them in order. This is not a good, better, best type of thing. This is like levels. So we want you to come in and walk. So someone else asked, like, they were asking about OTC stocks and like why people keep telling them not to trade OTC stocks when they're just getting started. And the example that I gave, or the analogy that I gave, was that that's like giving your 16-year-old a motorcycle for their first vehicle. You probably want to give them something safer than a motorcycle to start with, right? There's a lot you've got to take, like you got to get special license for the motorcycle or special rules. There's a lot of technical things you need to know, and there's more risk, and you need to know how to manage that risk to really enjoy the motorcycle and be safe. So tier 1, not a motorcycle. Tier 1 is your beginner, nice and smooth, easy entry, exit, easy stop losses, all that kind of stuff. Tier 2 is similar, but it's going to be a condensed time frame. So you'll buy and then you'll sell sooner. So that's where you're starting to get to be a bit more of an active trader, and you're getting more picks. And then tier 3, and I recommend, guys, if you're still here listening, I recommend just getting at least 1 and 2. And it's a 14-day money back guarantee. Don't like it in that 14 days, fine. But if you're getting at least tier 1 and tier 2, then you're actually going to be able to try them out. You have more of a chance to get more picks in during your 14-day period. There's no, you don't have to pass any type of test or anything like that. We don't do that. So Danny, the difference between tier 2 and tier 3 is that tier 2 is 4 additional picks. You're delivered 1 pick a week with all the research and all that type of stuff, and these are swing trades. So the entry and exit can be anywhere from 24 hours to a month, or maybe even more. So these are coasting trades. These are the explanation's all there, and you're learning. But we're not expecting you to sit in front of your computer all day, so that you don't lose money. We're trying to make these as easy as possible. We've done a lot of work to, and Matt works his butt off. It's not easy to find picks that are simple, as simple as possible. So we do a lot of work to make it work. So that 4 picks a week is reasonable. And then tier 3 Instead of just getting those SMS alerts and the emails and the access to the membership site, you're joining strategy call sessions at lunchtime with Matt, and that's where you get all the additional trades. Those are where you're getting the, hey guys, I'm seeing some crazy stuff going on with Ethereum right now. I'm thinking if anyone's long Ethereum right now you should probably take profit, and then we'll wait until it hits this level and we'll come back into it. Or hey guys, I know that on tier 1, I pointed out that there was a great opportunity with Tesla. I also think that because XYZ is happening, that we can buy some call options on this and really make some money. So you saw some examples during the presentation where he did that with some bank stocks, and it was like quadruple digit percentage returns. Kenneth, you do not get Matt's personal cell phone number. You can ask him. He might give it to you if you're really nice. If you buy tier 1 and tier 2, will you be offered tier 3 at a later date at a discounted rate? I don't know, and I don't think so. I don't know. So you'll get the webinar promotion if you do it all now. But it just by virtue of being a tier 1 and tier 2 subscriber, I cannot guarantee that you will have a discounted rate for tier 3. Do the recommendations include crypto? The only on tier 3, and the reason for that is that we're designing this product so that it's accessible to as many people as possible. So if we were to do cryptocurrencies as one of the 4 picks for tier 2, that would leave out a lot of people that don't have access to a crypto brokerage. So you're only getting the crypto picks on tier 3. And that's where it's just a call. It's very free form. Matt doesn't have to adhere to a rigid like 1 pick a week timeline. That's just strategy session. This is what he sees for the week. This is what he's trading. This is what people are talking about on trading desks. And then he'll talk about any cryptocurrency. Oh, we got the question, Alex. Will there be a replay of today's webinar? And this is the question I will end on. Yes, of course. If you registered for this webinar and are with us here in Zoom, just watch our email. You'll get a recording of the video. Do we offer lifetime access, Jeffrey? Ask Rodrigo. He gave you his phone number. He gave you his email. Rodrigo's your man for special packages. If you want to do something special. What is the $47 newsletter? Good question. That is just a bonus. That's completely separate. That's a one-time payment of $47. It's not a subscription, just a one-time payment. And that is the stocks to watch provided by the Benzinga news desk every morning during the pre-market hours. So the Benzinga news desk, they get their day started at 5 or 6 a.m. Eastern time. So they're watching the pre-market, so they get an idea of what the themes of the day are going to be. What are the stocks that are going to be? What are the stocks that are going to be the most active during the day? That's what that newsletter is. It's a great newsletter. It also provides trade ideas. I think it's an incredible value. No problem, Brandon. Hopefully the replay is educational for you. I think today was a really, really good session. I think Matt was on his game. Tim, if you work full time, does tier 3 make sense? Yes. We purposely designed it so that it works for like these are designed for people that have full-time jobs. And we want you to learn. If you want to be a professional day trader and quit your job, that's great. This is a stepping stone toward that, but this is designed for people that have full-time jobs. So the tier 3 strategy call sessions are at lunchtime in North America. And if you miss them, the recording and a summary, a very simple summary actually, in text form, is uploaded to the website once you're a paying subscriber and you have access to the membership site. So even if you miss it at North American lunchtime, you can still listen to it. Yeah, lunchtime Eastern time zone. So he was previously doing the calls at noon, but I think he started doing them a little bit earlier. I think he's doing them at 11 a.m. right now, and he'll let you know. What does lifetime access really mean? Is it rate? Is it rate is locked? I'm not sure what that question means. All right, guys. Happy Sunday. Thanks for spending some time with us, investing some time in learning about how the markets work and how you can look at stocks. Always a good idea. Hopefully this was helpful for you. And if you really liked it, subscribe to Matt's Stock Picks. It is worth it. It's not baloney. It's the real deal. Matt's the real deal. Um, if you don't like it for whatever reason, you get a full money back guarantee as long as you cancel within the first 14 days. So it's 2 weeks. And it's great. It really is. When Matt says something is happening in the market, I listen. And I'll drop Rodrigo's info in here. So the lifetime, if you're trying to get a lifetime subscription, just talk to Rodrigo. I don't really know exactly what you mean. If you're referring to the discount lasting for life, what I mean by that is that every subscription here is an annual subscription. So it's 68 bucks or $69 or whatever for a year. That's how much you're paying for an entire year, every year that you stay subscribed. The price will never change on you, is what that means. So it's not like 30% off for your first year or for your first 2 years or anything like that. It's 30% off as long as you stay subscribed. Can you please answer the question, if you want all three tiers, are they priced separately? Yes. There's only one way to purchase everything, and it's going through that process. And they're additive. I suppose that's the best way to put it. The pricing for each tier is additive. Can you share a sample of what a tier 3 call summary looks like? Sure. Yeah. Hold on one sec. I just have to log into the site. Ooh, the site got its update. Oh, this is sweet, guys. Okay, I haven't logged into the site since like Thursday. It just got its design update. Oh man, you guys are gonna like it. Anyone that's subscribing right now, woo, you guys are lucky. You're getting in just when we completely overhauled the design and the look and feel of the website. Dang, Rodrigo, if you're here right now, have you seen this? This looks so good. Big shout out to the Benzinga development and design team. Good stuff. All right, so I'm getting you guys an example of the summary that you get from a Stock Picks Tier 3 or Strategy Elite. So let's see. This is May 14th. So this is, it's a call and you get the recording and everything, but we also provide this text in case you just don't have time to listen to it. I'm pasting it into the chat. You're getting free trade ideas right now. Should video be live? Yeah, no, there's no video right now, Sean. Thanks, Leah. Have a good day. Thanks, Tony. Thanks, Tim. The summary's in chat. Just scroll up in chat, Sue. Thanks, Brian. It's not a black screen. There's a logo for the boot camp in the middle. Oh wait, no, it isn't. It just says Benzinga. Sorry. No, if you're not great with options trading, that's not really going to set you back. It's called stock picks. It's all about trading common stocks. The option stuff is just icing on the cake. And what is really good is that if you frankly, I mean, there's free stuff out there. If you watch some YouTube videos on just basic options trading, you're going to be able to join in on the options fun. It's not he doesn't do anything terribly complex with options. It's just very basic: buy a call, buy a put, that kind of stuff. Nothing came up on YouTube. Well, yeah, it's because I can't paste that much in YouTube chat. I'm trying to. Okay, fine. I can't paste it to YouTube. Here, let me see. I'm gonna paste it bit by bit. All right. How about that? There's a little bit. Some more. Oh, it's too much. YouTube's mad at me. Boom, bada boom. We got STNE, Stoneco. We're bearish on that. Details going in. Cloudflare, ticker NET. We have a neutral stance on right now. True, Rob Roy. Leah, good call. Rob Roy is a wonderful resource for options. And he is available on the all-day live stream, only on Benzinga YouTube. So I'm dropping the Tesla info in right now. Deborah, thank you. Congratulations. You're going to love it. Trust me. Yeah, I'm on Zoom. Wow. I think Matt's incredible. Like, I think Benzinga is super lucky to have Matt as a partner. I honestly, I wouldn't have expected that we would have gotten Matt Maley a year ago, but we did. And even during these webinar sessions, everything that I know that I talk about in terms of trading, I just learn from these guys that we work with, and Matt Maley increasingly is becoming one of my favorite people. One is because he's just always right. Kenneth, I bought all 3 tiers. What happens next? Now you should be getting number one is Kenneth. If you bought all 3 tiers, you should have been redirected to log into the site, so you should be able to see all of Matt's stock picks ever. You should have access to everything right now. You should have access to all of his recordings now if you bought all 3 tiers. From the strategy sessions, you should see all of the summaries. What you should do is look at the most recent posts for each tier and see if there's still room, still time, if they're recent enough for you. Otherwise, now you just have to sit back and relax and wait for the next alert. And just stay up with the schedule for the strategy sessions. You'll get emails letting you know every time, all the time details on the strategy sessions. And if there's ever a time change, like Matt has something going on with his family or he's going out of town or something, you'll find out, a week ahead of time, and they'll say something like, "Hey, we got to move this to 2 p.m. Eastern," or they'll say we're changing it to Thursday instead of Wednesday or something like that. just make sure that you enter in your phone number for the SMS alerts. Highly recommend it. So you're gonna get, it's just a better experience in my opinion. All right, thanks everyone. Have a good day.